Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Prashant and Sonia. We are in for a very important day because it's one day ahead of the weekly options expiry, and most importantly because it's the Fed event day. But of course, we will react to it tomorrow. As of now, what has the market priced in? A 75 basis point rate hike, which is in the price, but the market action, at least in India, suggests that even 100 perhaps is something which may not derail at least the Indian rally. But there's a global risk off, which is clearly visible across asset classes, commodities, cryptos, dollar index and bond yields. So for how long can we keep ignoring the global risk off really is the big question. The SGX Nifty is indicating that we'll start somewhere around the 20-day exponential moving average, which has been huge support for the market. Let's see if that gets defended or not. Guys, hi, good morning.
Hi, morning Anuj, morning Prashant. I like that title, right? Fed up of the Fed. I mean, all of us are pretty much. That's all we've been talking about for the last, what, 2 months, 3 months, maybe even 6 months.
More like a year, right?
What is the Fed going to do? And now I guess it's coming out of our ears. But in any case, you won't have to wait too long to find out what the Fed is going to do. There are 3 burning questions for me. One is this buy and dip strategy that has worked really well in the Indian markets. Is that intact? Second is, has India actually decoupled from the US markets? And the most important, does the Fed outcome really matter for an Indian investor? I mean, the equity cult is back in a big way in India. Retail accounts, as we said, 100 million retail accounts, in August. The question is that whether the Fed does 75 or 100, will the buying stop? And it may not. Just look at the kind of outperformance that we've seen in India already. The Nifty is up 2% this year, while almost all developed markets are down about 20% apiece. Yesterday as well, both FIs and DIs bought in the cash markets. There was buying of almost 1,200 crores by FIs. DIs bought as well. Yes, the US markets are under pressure, and yes, we may open in the red, but that may give the bulls an opportunity to buy. More than the rate hike, I think it's the Fed commentary that assumes importance on what the Fed would do here on and what the trajectory is as far as both inflation and growth are concerned. So I'll watch out for that. But as we negotiate all of those cues, our own markets are hitting new highs. So a long list of large cap stocks sitting at fresh 52-week highs. And most of them are, domestic, economy-facing consumption stocks. So whether it's ITC, Ambuja, Maruti, TVS Motor. That's the big question, right, Anuj? This buy on dips is something that has worked. Does it really matter what the Fed does?
No, it does matter, of course. When everyone starts saying that perhaps it does not matter is when, you'll have a reality check, Sonia. Look, I mean, if US falls another 10-15%, at some point we will catch up. But for our market, there's just been very strong sort of market texture. Yesterday I was making a point that the big data to watch would be the FI positions in futures and options, where you have aggressive shorts, and that shorts are beginning to throw in the towel. Now look at what happened yesterday. There was huge short covering. In fact, I think this is the single largest day of short covering. 20,000 contracts net covered in a single day by FIIs. What that means is that the net shorts are now down to 25,000 contracts. I think this was well over 75,000 at the peak of FI shorting. In fact, when the series started, FIs were 82% short. That's down to 61%, but that's still short on 61%. So maybe there's more short covering left. I think there are a couple of levels to watch out for and defend. Normally on days like today, first, of course, you'll keep an eye on yesterday's low, 17,744. If the SGX Nifty is right, and that's a big if, I might add that's a big if. In that case, that will go. And if that happens, then of course the SGX Nifty low and the 20-day exponential moving average, the 20-day simple and exponential moving average, both are now placed at 17,690. So 17,690 is your risk reward equation, and you get closer to 17,690. My sense is longs would come back in this market and try their luck with a 40-50 point stop loss, because that would be a good 4:1 or 5:1 kind of risk reward if the Nifty has to defend the 20-day exponential moving average and go towards that 18,000 mark, which is what the basic impulse of this market has been, to buy the dip. But buy the dip where? So I think today perhaps the market gives you that opportunity where you straight away open at a very strong and a very significant support level. And I think the other way to play that is on the bank Nifty, because that's really been very strong. It's not even broken its 5 or 10-day exponential moving average. Forget about the 20. And those averages are placed at 41,050 to 40,700. And if the market is charitable and gives you that sort of zone, my sense is that is the zone in which you will see buying. And look, the FI buying is so strong now that all these financial especially and the domestic economy facing stocks may continue to do well, may continue to see an uptrend. Of course, with the premise that there should not be complete capitulation in the global market, because that's something which perhaps could derail. But Prashant, morning, there's a new angle that you're covering this morning. What's happening with Russia?
Just because there is too much of Fed and we were fed up of it. But it might be significant as well, to be sure. We don't know. So this is something which is going to happen in the next 2.5 hours or so. So Russian President Putin is expected to sort of release a pre-recorded speech. Now, this is according to Forbes Russia, and they're citing Kremlin sources. By the way, if you saw the social media, etc., last night, it was a buzz because the speech was supposed to come last night, and then it never happened. I mean, no explanation was given as to why the speech never came, but this was expected to come last night. But now they're saying that it's going to come at 10:30 a.m., and this comes at a time when it's being widely reported that Russia is basically losing ground to Ukraine. I mean, the Ukraine counter-offensive is being successful, etc. There's one more thing. In Russian-held territory, in many sort of regions in Ukraine, there are referendums going to be held, where now, you basically call for a vote and a referendum, and the region officially joins Russia. What reports say, and this is not me, but what reportage is that this may be an escalation in conflict, because Russia wants to give itself, enough sort of whatever legal cover to call any further escalation as an attack on Russia itself, and give itself the powers to kind of respond much more aggressively. So we'll find out. We don't have to wait very long. But if it is that, and if this is a serious escalation, then it will mean a lot of things. By the way, I mean, there were no significant cracks on the back of this in global markets. The Russian stock index sold off big time. Wheat futures, for example, jumped 8%. But apart from that, here and there, not very much. But it could turn. So keep an eye on that. Now I come to, of course, the Fed, which we've been kind of talking about. So last night, again, I mean, more of the same. Stocks were down by about 1%. Yields back up. So the 10-year is back above 3.5%. Technically, it heads straight to about just under 3.8%. The 2-year, by the way, is at about 4%. Thankfully, one big component for India's macros, oil remains helpfully low at about $90 a barrel. The dollar is surging. It just fell short of making a bullish outside day. So it came off a little bit, but still above 110.25 on the DXY. And, what's coming out of Europe is being largely ignored, although we've got a couple of central bank decisions this week from there. But extremely hawkish commentary from ECB's Lagarde as well, reiterating the determination to bring inflation back to 2%. So commentary from around central banks and around the world, very, very hawkish and very, very determined, focused on inflation at this point in time. Sonia.
Absolutely. I think the commentary is most important, right? They're getting into restrictive monetary policy territory. And I think this is the first time that the Fed has been tightening rates for so long to fight inflation since the 1980s. And this will be the highest that we've got if it's a 100 basis points rate hike. It was unimaginable about maybe 6-8 months ago, right? But it's coming through now.
But the quantum, if you compare it to the 80s, I think they hiked rates by some, I think 10%, 10 percentage points.
Okay.
This is what, I mean, from zero, you've gone to whatever, 2.5 or something like that, right? I mean, 2.5 to 2.75.
The quantum is not as much as what it was perhaps way back in the 80s. Okay. But nevertheless, I mean, restrictive monetary policy territory is something perhaps we need to get used to from an equity market standpoint as well. And that's the reason why the US markets have been under so much pressure since the start of the year. But let's do one thing. Our market is a different beast altogether. So let's tell you what you can expect. On the equities front this morning, Jonathan Garner of Morgan Stanley is our expert of the day. He says that they have repeatedly emphasized that patience will be rewarded by the end of this month. He says this will become the longest bear market in terms of days in the history of Asian and emerging market equities. He adds the recent Jackson Hole speech by Fed Chair Jerome Powell and the mid-September upside surprise in the US CPI will likely accelerate a move down towards their bear case target in the near term. He says this raises the likelihood that a classic capitulation trough could form most likely in the month of October.
Okay, let's get you some money market views then. Kunal Sudhani of Shinhan Bank says the US dollar index gears up for another hawkish play of the Fed today, taking rounds around 110 plus levels with the potential to test last high of 110.79. He says the US government bond yields extend their bullish route to fresh multi-month high and oil prices have cooled off. He says it's also important to keep an eye on Chinese yuan as well. For the USD INR, Kunal says 79.60 should be a support, while somewhere around 80 will be a resistance.
And on the bonds, Neeraj Gambhir of Axis Bank says that the market has started the week on a negative note on the back of continued rise in the global bond yields. He said the FOMC rate decision and forward guidance will be the key driver of bond yields over the next few days, and expects the 10-year benchmark bond yield to trade in a range of 7.25 to 7.35% for the week.
Okay, all right. So that's basically